everyone. Will you please confirm I'm audible? Okay, and quickly now recording is started. So as part of the attendance also, uh, I appreciate if you guys while joining put your correct name. So the same we will take as a part of recording. It will mark as the attendance also. And this attendance we will ensure during the session also. Because our objective for this corporate tax training to support the professional who are really interested to upgrade his skills. Because normally is here is shown the 29 participant and thank you everyone. And continuously Mr. Sayed also is highlighting the inactive member who's not joining, that will not be part of this group anymore. So maybe the next session, the people, if it's not appearing, so they will not be in part of the upcoming training session. And before starting that today's session, we have the couple of questions for the CPD. I replied in the group also. See, as a part of this voluntary initiative, I'm doing my best. I already have the registered company in the UK with the name of PTC Corporate Consultant Limited. Okay, as part of this company, they is authorized to offer such trainings. As long as the company authorized or he have the activity to offer such trainings, and we will issue the certificate, and mostly the professional body, they do accept the such certificate as part of the CPD. Now, on top of that, we are still working on that, if the further credential to the same, although the same certificate will be accepted, the further credential, we are working to add on that certificate also. What is the further activity that we are trying to do that? There are many credential bodies as a part of CPD. They are giving the credential to the any of the service training provider institute. So that will be added as the additional, the one logo on the certificate. That's still in process. Hope I'm not committing this part, but I'm trying my level best till the time we will finish this. This will be added in the our profile also. Hope so far the this topic is understandable for everyone and the clarity everybody have. And one more question, the mostly people is saying then due to name, okay, mostly is common in the term of the female, their name will be surname will be changed. The practice maybe most of us are familiar. This is acceptable. If the previously you may request to the the professional body, ACC, ICW, or the any other body, you give your the documentation. They might update your the membership certificate also. This is the one of the option. Another one option, you may give the same name that is written on the same on the ACC or the ICW, whatever the membership certificate you have. You share the same name. We will give you the same certificate under the same name. We will do our counter check and ensure to support such matters. Hope this point will be understandable for most of us. And here today we are. There is some new participant may be joining in this session from another group that unfortunately was getting skipped in couple of previous because I have a lot of other the initiated the voluntary tax training, but due to time limitation, all the things is not able to manage. So I'm trying to merge in the same group. That will be continue, and whatever the other things in the other group will continue and discuss on the other topic. So no more discussion on this subject, the CPD, and the new participant. We appreciate if you will be remain active and take this additional the training or the knowledge that will be helpful. And the one more thing, I appreciate, okay, some of the participants, they do send their request on the WhatsApp with their query or some whatever the query they have. Yes, they can raise the query, but I appreciate if they mention their name also. Sometime, I will now today most of the people is share the name. I'll try to add the name also. But I appreciate in the first few queries, if you share, the name will be added, and I'm able to respond on such matters. But on other side, on daily basis, a lot of queries we are receiving, I'm receiving as well. It would be, I request and advise if you share your question, and the same day when we have the training, same day in morning or before training, you share all the question. In the training, the first 10 minutes, we will try to answer this question. Okay. And one more important thing, the objective of the subject groups. Okay, objective of such group where like this is one of the PID platform where he needs, they are also doing the support to the professional community. They are doing good job, and with their coordination and the cooperation, we are here on this training session. To try to follow the rules of each group, because their objective to support the community, and if try to minimize your communication, only the relevant question on the same day of the training, like today we finish the training, whatever the question that you have after the training, even the same day you can send. But apart from that, the next session, when the next session is coming, the same that day before training, you can send the question, and avoid the discussion on that. In the training, we will add some additional time to answer these queries as well. Hope this point also is understandable for everyone. Now, the one more important that I skipped today, unfortunately, due to certain reason, I'm not able to be take the training on time. 30 minutes delay. My apology for that. And let's take the question that most of the participant have the question. I will try to address this question. While trying to address this question, one question is just now, Ms. Farhana is referring the SBR raised in the group. Okay. See, I can give the answer, but I will appreciate Ms. Farhana come forward, and I'll open the mic and raise the question. And before raising the question, what we learned in previous session, regarding the SPR, and what is their understanding, and based on that, because this is important. Okay, even I'm giving the session, and if your understanding is not getting the build up, so that will be not the productive. So my I will try my level best to whatever your understanding for this regulation or the implementation. Most important the implementation, because if you understand in a right way and implement in right way, so such question will not be arise. So now my key point to understand where we are standing in terms of your understanding of this SBR, then based on that, I'll respond on that. Thank you, Ms. Rana. Please share your point of view.
Assalamualaikum. My question is, it's a little confusion maybe, that as we studied that for SBR relief, if a business which has revenue less than 3 million, they can opt for SBR and they don't need to pay the corporate tax. Though they will register, but they will not pay. However, my question was earlier also, what if their revenue is less than 3 million, but still somehow their profit is more than 375,000 threshold. So will they pay the tax on that or not? As per our last discussion, you said that they will not. However, today somebody else shared the screenshot and they were showing that they will pay. Even if their revenue is less than 3 million, but their profit is more than 375,000. That is my query.
Thank you. I appreciate the one of the participant, Mr. Nishar. Maybe he raised the question. I'll open the mic and let him give his point of view. Because see, My response will be maybe based on my practice and experience. But what is the understanding of where the question is coming? If you give his understanding, Mr. Rana is share his point of view, so I understand where the gap is there. See, if I'm not saying we everyone knows, but your question will be comprehensive, and I love to answer on that. Mr. Nishar, if I'm hope I'm pronouncing it correctly. Nisar. I'll open the mic. Yeah. Uh, Nisara, would you please open your mic and please share your point of view on that? I think then this female name, Nisara. Would you please confirm, are we able to answer on the, open your mic and speak on this?
Assalamu alaikum.
Walaikum salam. I'm good. Thank you, Mr.
And this, I just shared in last session. This is confusing me. This profit before tax. So, is this an additional information, or we need why it is given? This is my concern. Is this is and because EBITDA is given, EBITDA we have calculated 30% of that, and then 12 million. Uh, so this profit before tax is given. Is this an additional information or what?
Okay. 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 Thank you. I'll come to you on that. But somebody share the SBR ones. I will come on that, but let me get the SBR one. That is one of the. I'll share the slide also and come on this question also. But before that, please, one of the participants who raised actually SBR point, who raised the SBR point, please come quickly and just even might be you share the here the point also. On this. Mr. Nishar, the question that you Ms. Subera, you shared. Would you please, I'll open your mic and please. Yeah. Yes,
Hi,
please.
sir. Assalamu alaikum and everyone. Good evening.
Thank
Actually,
you.
I raised this question after reading that cabinet decisions and further clarification for that one. But I got the clarification when I read fully. It's that if we are opted to elect that SBR relief, then we can avail that option. And if we didn't elect, then we cannot. That was, I got the answer even after reading that guidelines.
Okay. So if you again just give the brief understanding so
And
other people will
And now,
understand.
sir, one more thing. There was written that even if we are elected for the SBR relief, so we have to file the simplified tax return. Am I right? We have to do this one. We cannot skip the filing, right?
Right.
Okay.
But
Thank you, sir. Thank you.
just the previous point again, would you please explain the previous point? What is your understanding? Uh,
Uh,
because of other.
Yeah, I'll go with that.
Yeah.
Actually, when we read that table, and it was quite confusing. When we read the elaboration further on this, so we got that they give us explanation that if we elected the SBR relief, SBR as election, so then we can get this relief. I mean, we can save this much tax for the corporate. If we are not election, we are not under the election, SBR selected that option, then we will not be able to get this much relief. We have to pay the tax, CT tax. That was the table.
Okay. Thank you. Ms. Farhana, would you please, I believe you can open your mic and please confirm your understanding is now clear, or still you have the point? Ms. Farhana, would you please try to open your mic? Okay. Okay, fine, thank you. Okay, now the point over here, the Ms. Zubaira also confirm and Ms. Farhana also confirm. I just want to give you the 1 point understanding. Just quickly respond in the chat also. The simple question, is the SBR is a mandatory or the optional? Is the SBR is a mandatory or the optional? See, this practice, what we are doing, okay, this will help us to, synchronize our understanding. Because such point while implementation, we will face the difficulty. Okay, now as long as this relief is optional, so if we opt, okay, then our return will be closed, as Ms. Zubaira is saying, will be simplified. What is the definition of simplified? Simplified means the whole return will not open. Now, when we opt for the SBR, this will be our election. On this point, after that, only the 1 step and return will be closed. After 1 step, our return will be closed. So this is the simplified return definition. So now in terms of the optional, okay, if the optional, okay, we have the option, we can opt for that. But what will be the rationale? What will be the rationale we will opt for the small business relief? And is there any scenario where we will make our rationale and our analysis, our study, and we say, okay, now we will not make the SBR? Is there any possibility? Is there any scenario where we may opt and we'll say we will not opt for the SBR relief? As of now, Mr. Raja, we are discussing if revenue is less than 3 million. So we are in a position to claim the SBR or opt for the SBR relief, but we will not. Yes, some of the participant gives answer, Mr. Shahab. Yes, the losses. In case of losses, the rationale in case of losses, if we are in a loss position, we analyze our business in the initial startup phase or in the certain stage of the business, we have the losses. So then if we not offer the SBR, then we can carry forward the losses. This will be one of the other point also, maybe, but this is one of the, the basic understanding that we will go through. Now, if we are discussing part of the group, okay, the group again is another discussion, but that will be the based on the group, if part of group, then we will go through that. But again, before joining the group, again, we have go through, okay, if we are in a loss position and we can claim the SBR, so shall we claim or we shall take the losses and carry forward? and the losses can be carried forward for the unlimited, for the indefinite, and the losses can be how will be utilized, that we will discuss how will be utilized in the group. We will discuss indefinite. We can Mr. Qasim, we can carry forward the losses. Only the interest capping rule we carry forward up to 10 years, but losses are indefinite, we can carry forward. And how it will be allocated against each tax period in the future, that also we'll discuss in the losses. Normally, just for basic understanding, 75% of the existing current year, if the losses carry forward from previous year, the 75% of taxable amount equivalent that we can allocate the previous year losses. Hope now we have the understanding up to this, and let's come back to the topic. There is one question, I believe one of the participants, Mr. Nishara, I think in the financial period revenue. See, here his question was, there is some additional information. If I got skip that part, in the financial year ending, LLC revenue of 200 million, okay, and adjusted EBITDA is 180, and profit before tax is 140. Yes, Ms. Zubera, the SPR is still 31st December 2026. I think I did not share the screen. Let me share the screen also. Okay. Okay, there is one question point was one of the participant. Quickly, I'll take that. Participant. Sure. Yes, Mr. Nishar, would you please open your mic and quickly, please raise your question? Unfortunately, I skipped the part that you are raising some information is Mr. Nishar. And I appreciate if you give the slide reference number, that will be more easy for to open the same slide. But anyhow, if you able to open the mic and please ask the question again. Today our topic is, yeah, now I'll move to our today topic. Yes, please.
My question is, there is one additional information is given, profit before tax. So this is an additional information because there's EBITDA, we know that 30% EBITDA or 12 million. So this, my question is only this, that profit before tax, why it is given 140?
Okay.
So this is an additional.
Okay, see, normally the example are prepared for understanding in which information are shared. Maybe you understand one of the part and some other additional information will remain there. Okay, it is the same way in the financial statement. What is the financial statement? How will present in the financial statement? We'll give all the required element in the financial statement, right? But maybe
Right.
all the information is not able to use in the tax while preparing computing the taxation. Okay.
Correct. Okay.
So
Correct.
that what are the basically, if you question see the header, there is some assume all the taxable person are taxable. So such assumption will remain there because we have to understand the topic. We have to focus on one topic and putting some assumption also for understanding purpose also. Okay, let's.
Okay. Thank you.
Thank you. Thank you. What is the today our topic? What is the today our topic? What is the our today topic? Yes. In the one of the participant I need who because we have the discussion in the last session. You will go through the previous recording and what was the topic that you have to go through and what is your understanding. And because I'll cover the topic today, but I would like to have the understanding where we are standing so far on that. Please quickly, what is today our topic? No response. Nobody go through that previous discussion where we are discussing, okay, you guys will be go through and will cover the topic. Yes. Fawad Aziz, yes, our topic realized and unrealized gain and losses. Gain and losses. So please confirm. Hope you guys are the go through that recording. Please confirm if you go through. So what is the understanding and is there somewhere you are having the point that you want to discuss on that? Please quickly share the same link in the chat also, and the people can, if somebody skipped, so I appreciate one of the participant if you can take the link and share in the chat also. But unfortunately, there is a few people who comment on that, and I'm not sure. Okay, let's. I was expecting you guys cover in this topic. So this is the screenshot I taken from the corporate tax return. I'm gonna start this today's session on the election. And under election, we have one of the topic that is the unrealized gain and losses. Unrealized gain and losses. This is the our today topic. Unrealized gain and losses on asset and liability under Article 20. Under Article 20, one of the adjustment under Article 21 of the adjustment. This adjustment is part of the tax computation. While doing the tax computation, we go through in the previous session. Today the topic is the tax computation, but let me quickly give you the understand because I believe the most of the people stop share. Unrealized gain and losses. Okay, now I hope you guys can see the screen also. Today our topic is unrealized gain and losses. Realized and unrealized gain and losses on asset and liability, Article 20. So I just added under what are the things we will cover over there. Transitional gain and losses, not taxable, arise at the start of the first tax period. So the transitional, this is a very important part that we have to understand. What is the mean of transitional gain and losses? I'm going to mark this. Transitional, because this we have to understand. Transitional gain and losses. So what are the transitional gain and losses that will be now here the one important part, the transitional gain losses, like the now if we are assuming, let's assume our tax period is Jan to December 2024, we'll keep the assumption and a now onward session for discussion purpose. So what will be the transitional gain and losses? And it will be coming from 2023, from opening balance of 2024. So that opening balance, we have to make some adjustment and see how much is the transitional gain or losses that is coming carry forward from 2023 and that have the impact in the 2024 or upcoming. So this amount effect we have to give in the return. In the corporate tax return, we have to give these figures. How many the gain and losses carry forward from previous year and how much we adjusted in 24, because the opening balance that giving in the first tax period, it is the part of the transitional gain and losses, and mostly management or the internal team already recorded the transitional gain or made the provision for transitional gain and losses. If they some companies not made, so they have to focus on that and work on that, the transitional gain and losses. Under that, here the mention the first tax period. First tax period. What is that? This is the cutoff. Cutoff normally as per the financial, the people from the financial qualification or the professional qualification, they're familiar with the cutoff. So the tax authority needs the cutoff. Okay, if any impact is carried forward from previous year, it may affect the current year or the future tax period. So what is the amount of tax and how much is adjusted over there? So they need this information. Now, immovable property, intangible asset, financial asset, and liability. This realized, unrealized gain and losses. This area will be affected. Immovable properties, intangible asset, financial asset, and liabilities. So let's see the taxable adjustment. So now I just open the same slide just for understanding purpose from what the topic that we are starting. So from where we are starting. So actually our topic is the taxable adjustment. Why we are doing taxable adjustment? Why we are doing? Because we started computation from the accounting profit before tax. For what purpose? To calculate the taxable income. To calculate the taxable income, we started the adjustment in the accounting profit. As per Article 20 of the city law, there is a 8 adjustment in the accounting profit we have to make. Why we are making to compute the taxable income. So we already discussed in previous session, and the recording is also available, and most of the we already upload on the YouTube also. So let's go through the. I'm not going to discuss the previous part. I just want to highlight the today topic that we're going to discuss. Actually, this is our topic. We are discussing the 5th adjustment. Out of the 8th adjustment, we discussed already the 4th adjustment in very detail, and we have very detailed understanding on that. So now we are discussing the unrealized gain and losses as per the Ministerial Decision 134. So if you are looking for the reference, you may go and understand the Ministerial Decision 134. And what we're gonna understand today. So in case of unrealized gain and losses, what are the election option is available, and why we have to opt for the election, and what are the understanding and rationale behind that. So let's move to the next. So this is the corporate tax return. From corporate tax return, so this is our topic today. This is our topic today, election. Under election, we have only one election that we're gonna discuss. Under election, we will discuss only one point, and that is unrealized gain and losses. So here we are in terms of the corporate tax return, and let's see to the topic. Here I just add the point, one of the slides, why this is important. Why the election is important. The unrealized gain and losses. Why is important? Unrealized gain and losses on all assets, liabilities arising from, okay, on all asset and liabilities arising from which activity we perform under as a result or the outcome of that activity, the unrealized gain and losses will be arise. So these are the three activity as a outcome of that, the unrealized gain and losses will be outcome. The fair value are the impairment accounting, non-taxable and non-taxable and the non-deductible. Okay. So capital item, non-taxable or non-deductible. Revenue item, taxable and deductible. Okay. So the point here, non-taxable and non-deductible, there is a two category is there. We have to consider in the tax computation while looking into the impairment, while looking into the election, these area non-taxable, because if it's non-taxable, is that line item or the transaction or that adjustment, or we made the adjustment in the financial statement, do that impacting the accounting profit, as a result of accounting profit, our taxable income getting affected? And in case of non-deductible, so we have to see whether what is the effect. So the reason the highlighting here, the both point, we have to focus on both sides. Maybe we are saying, okay, this is the non-taxable and non-deductible, it will not get effect on the taxable computation. No, we have to look the both side. We have to look on the both side. You may not understanding will be here, but down the line your understanding will be refined. Now we're going to understand the impact or the tax planning. Financial statements are prepared on accrual basis. Accrual basis, which means this election will be available if we are following the accrual basis. What if we are following the cash basis? What we are following the cash basis, which means this election will not be open. And who can follow the cash basis accounting? Quickly, please respond in the chat. Who can follow the cash basis accounting? I appreciate quickly. Yes, less than 3 million. Less than 3 million. Okay. Now the tax payer may elect to apply one of the following points. One of the following, now that if we opt for the accrual basis, so we have the option to below option in respect of the unrealized gain and losses. So what is that? So now this is the election. This is same, but screenshot. This is shown from the return. Now mostly the participant are the where we are having in the with the client or with the training. The participant or the professional is saying, what is the election? How we will opt for the election? Is there some button or just as a part of the understanding the as a part of rational? So this point was appearing in the conversation. So what I did, I taken from the return and added over here. It is in the same way it will be shown. Realization basis, okay, you have to opt yes or no, yes or no, okay. So what does that mean of realization basis? If somebody wish to give the understanding what is the realization base, the literal meaning or the accounting meaning, because in accounting we and which standard are dealing with such scenario. I appreciate if quickly you guys reply on that. I'll give one of the point, but I wish somebody else add one more point. Okay, now then one more. When gain actually realized, guys, quickly, I appreciate all of you to participate in that. We are looking your participation in that. Even whatever the understanding, please reply on that. In case of actual receipt of gain and losses, but on which scenario gain and losses will be there? On which scenario gain and losses will be there? Yes, Ms. Farhana has mentioned liabilities settled are assets sold. Okay, now there is another point. Okay, Ms. Farhana give the answer. Another one of the participant is that the expenses are income recorded or incurred. Okay, so now another point. Is there we can say the revenue item where we have the capital gain and losses in terms of the realization basis, and is there capital item also? We can have this couple of examples in terms of the capital asset or in terms of the revenue item. Just quickly, the basic understanding of the capital is this. The capital item name, capital item name. What will be the capital item on that? We might opt for the realization basis. Yes, sale of land, plant and machinery, PPE. Yes, the PPE. And the PPE have the three different, yes, the fixed asset. Okay, this is now we have the understanding of the capital item. We have the understanding of capital item. The PPE, capital asset, land and machinery, plant and machinery, land and building. All now because the point I'm asking, the point I'm looking for this conversation. Why? Because there is something else that you have to understand, because now that we already understand the capital item. Under the realization basis, there is a two part. One is the capital item, one is the revenue item. Now capital item we already go through. And what will be the revenue item? Quickly reply on the revenue item. I appreciate quickly respond now revenue item. Stock, receivable, inventory. I appreciate more participant quickly, inventory. Would you please give me the example on inventory? What is the condition or what is the scenario or the possibility where the realization basis or unrealized gain or losses will be appear? And which standard is dealing to inventory? Which standard is dealing? NRV, yeah, NRV. So as a result of NRV, what we are doing as a result of NRV, what we are doing? lower of cost, we are booking the provision. As a provision, we are doing the expense to the PL end. Am I right? Am I right? The inventory is still with us. Inventory is still with us. We are making the provision and expense out. And as a result, our inventory is still our inventory is still with us, but we said, okay, the value of the inventory is reduced. Let's say our inventory value is a 10 million, but due to slow moving as per, under the guideline of IS2, we said that the year end December 24, our inventory value is a 8 million. As a book value is a 10 million, but as per the standard guideline is 8 million. So what we did, we made the 2 million expense out in the current year. 2 million we expense out in the current year, and we made the provision for that. Am I right? But our inventory is still there. Our inventory is still there. So now, can we say this is the realized gain or unrealized gain? Can we say as of today, as a application of IS2, the gain we recorded is realized or unrealized? Guys, I'm trying to my level best to give you the concept of this. Even before starting today's session, this base concept is, if you got the clear, trust me, the whole topic will be covered. Even you agree or disagree with me, but try to participate and continue the conversation. This conversation is, you might feel is a one-to-one conversation. If you are responding, keep understanding the point and proceed further. Okay, this is the, as of now, we said this is unrealized, because when will be realized? When the asset is sold, that will be realized position, but currently is a unrealized. So now, if as of now we are on the unrealized position, we made the provision as of today, and our accounting profit, because we made the 2 million as a expense out, so our accounting profit will be reduced. And if accounting profit is reduced, our tax liability will be reduced, right? If our tax liability will be reduced, so we can opt for the realization basis. We can opt for the realization basis. If we opt for realization basis, this 2 million, we are saying when it, in term of the corporate tax, we are saying when actually asset will be sold, then this 2 million maybe is actually the 2 million or 1 million. When actually asset is sold, what is the actual loss we will record in that tax period, in that accounting period. Accounting period and tax period both are same. We are saying in the year of sale, we will record this. Now, if we say would the taxable person like to elect to use the realization basis? We are saying no. If we are saying no, which means we are opting for the unrealized basis. Unrealized basis mean the expense out, the 2 million already recorded as expense out. So as a result, we will pay the tax, less tax in the current year. Less tax in the current year, because we opt for the unrealized basis. If we opt for the no, so which means we don't want to opt for the realization basis. Actually, once the asset is sold, if the loss or the gain or loss, based on that we will pay the tax. But we are saying no. If we're saying the no, so which means this year we will have the impact of this, and as a loss we are paying the less tax in the current year. So we can record on the same 2 million, we can keep record in the that we already recorded in the accounting profit. We will not make the adjustment in while doing the city computation. Will not make the city adjustment in this. Will not make the adjustment while doing the city computation. Okay, no adjustment. Now let's take the other way around. Let's take the other way around on the same point. Let's say our asset is inventory is a 10 million, and now our inventory value, due to the market prices at the year end, due to market prices, the value of the inventory. See, Now we will not go to the further conversation. I'm just taking the scenario. Our inventory is a 10 million, but due to market condition or the prices of the subject item, now inventory value is a 12 million. So which means 2 million is a gain. 2 million is a gain. I'm not concerning the standard or the other. Just take the example. Now our inventory is a 12 million. Just take as an example. Don't get confused. Just take the concept understanding. The same concept. Okay, now our inventory is a 2 million. Don't mix with the accounting and the accounting standard. Now I'm saying just scenario based. Take the assumption, and our inventory is a book value is a 10 million, but the due to market prices, our inventory is a 12 million. Now we record the 2 million gain. Okay. Maybe standard have the different understanding. Now our inventory is a 12 million. Our inventory is a 12 million. So we are saying, what we are saying? We will, the 2 million gain will be go to profit and loss or no? Earlier we seen, let's assume, we will go in the OCI another part. We will go in OCI another part. Let's assume that, just understand, catch the concept. The 2 million came to the PL end. We will discuss the OCI another topic. If this 2 million part of the profit and loss, so your accounting profit is more, and we opt for the unrealized basis. As a result, we will pay the more tax. As a result, we will pay the more corporate tax. So hope the point you understand. So what is the realized basis and unrealized basis, and what is the impact on this city? So hope this point is understand. Okay, now let's move to the next. Okay, now here we are discussing no. We have already seen the understanding. If we go for the no, so we will pay all the things, whatever the gain or loss in the year in which we made the as per the accounting standard, we recorded the unrealized gain in our profit and loss. So we will keep the same, there is no adjustment if it's a gain or loss, because now we took the inventory example. Just take the asset example, plant and machinery, and do the same calculation. If the plant value is reduced, so then it is a loss, and current year will pay the less tax. And if the plant value is increased, so if it's coming the profit and loss, so we will pay the more tax. So now we have to move on, and the same year will pay. Now we are saying, okay, would like to opt for the realization basis. Here we select the no, but in the next case, here I am. The realization basis, okay. If we opt for yes, this is the return part. Okay. When you say the yes, the next window will be open. Is the taxable person a bank or insurance provider? Is the taxable person a bank or insurance provider? So we have to say yes or no based on our industry. And why this question is appearing? This is the important part. Why this question is appearing? Because under the realization basis, we have two options. All the assets are subject to fair value or the impairment accounting. When we opt for the realization basis, we will have the further two options, and we have to opt for one of them. We opt for either all assets and liabilities that are subject to fair value and impairment accounting. Hope this concept, the point is understanding. All assets are the second option. Here the all asset held on capital account. The difference is capital account. Here all item, which means the revenue item and the capital item both are covered. But here is the capital account, only capital asset, only the fixed asset. Hope this point is also understandable. The capital asset and liabilities, so here is coming all asset and liabilities. Just for our understanding, if we say, just for our understanding, we will make some name that we might use in our. We might say this is the. Okay, no, this point is. Okay, this is when we talk about all asset, and liabilities, we will say the option A. There is no option A in the FTA guideline, but just to for our understanding, and that will help in the upcoming the session also while understanding the example. We are saying the all asset and liability. We are saying this is the revenue. So when we are saying this is the revenue item, so we are just mentioning the A, and here we will say option B. Okay, option B for capital account. Option B for capital account. Hope this point is understanding is clear. So under realization basis, when we opt, here we have the two options. One is the option A for all asset and liability. Okay. Sorry, it's not revenue. Here the revenue plus capital, both. And here is only for capital. Capital means plant and machinery, land and building. The different standard is dealing. We will see what are the standard and what are the further part. And here if we are saying the our organization is the taxable person is a bank or insurance. So for them there is if you opt for the yes, so then only one option will be there for the financial institution. That only one option will be there. That will be, I believe, is the all asset, the option B. Would you please confirm that for bank? Which option is available? If we are the financial institution, so then only one option will be remain there. Other option will be disappear. Yes, because I put A and B, and I believe if you are understanding the same page for our discussion, we are saying the B. By default, when we opt, it will be one option will remain. But we are for understanding is discussing. But now normally most of the company what we are belongs to that is not the banks. Okay. So let's say we have the two options, that is the A and B. We have to opt for the A and B, and we have to understand what is the company rational, company operation, and which option is suitable. Which election we will opt. Which election we will go for A and B. So would you please give me any name or any analysis based on that? We'll say, okay, we will take the option B or we will take the option A. Just quickly, if any point or any understanding, if you quickly share. I appreciate if you quickly respond on that, if you have any example or understanding. See, this analysis are may vary based on each industry, based on each business operation. So you have to see which election is suitable for you. Which election is suitable for you? For you means that maybe for your client or maybe for the company that where you are working. So which election is suitable, and accordingly you take that option. But if there is no understanding getting developed, just take the option B, capital asset. Okay, because no revenue item, just take the realization basis and option B, asset and liability held on capital accounts. will just opt for this option. But I'm just for this is just for general where we do not able to establish. In most of the cases, maybe this is the suitable, but I'm not recommending to go for that. But just as a average analysis, we are saying maybe this is suitable for most of the business. But you have to do as per your rationale and the calculation. Now let's see the option A. What is the option A? In terms of the option here we are discussing elect to recognize gain and losses on realized option A, elect to recognize gain and losses on realization basis for the UE city purpose for all asset and liabilities. Okay, here very clearly as such any or all unrealized gain would not be taxable. And any and all unrealized gain would not be taxable. So what we are saying here, unrealized gain would not be taxable. Which means whatever the adjustment in accounting profit we made, we have to reverse, we have to add back. If we added, we have the losses, we will add back, and if we have the gain, we will minus the gain. Here, the gain would not be taxable, which means the gain is added, we will minus the gains. And on the other side, conversely, any losses, any unrealized losses would not be deductible. So if there is losses, we have to add back the losses until they are realized. Until they are realized, or we may say in the year of sale. In the year of sale, we can add into the city computation. Here, the one point earlier one of the participants also mentioned, but I'm not coming to this point so far. Let's take the option B, and we'll see what is the option B. Elect to recognize gain and losses on a realized basis for UE city purpose for all asset and liability, using all asset and liability, but for capital account only, We already understand what is the capital account, and we already understand what is the revenue account. Only the 2-point option A, revenue plus capital, option B, only the capital. So here, as such, any unrealized gain or losses in respect of the asset and liability held on capital would not be taxable or deductible until they are realized. We are saying if we have made any adjustment in the accounting profit, that belongs to the capital account, the plant and machinery, land and building, or any liability. So if we added in the accounting profit, we have to make the accordingly adjustment. Here, any revenue account like stock and inventory, unrealized gain and losses arising from the asset and liability on revenue account, on the other hand, the continue will be included. So what we are saying, if we have the adjustment belongs to this, it will remain there. We will do nothing in this regard. Whatever the accounting treatment as per the applicable IFRS we already did, it will remain there. We will not make any adjustment in the item belongs to in revenue item like inventory. We already seen the NRV at NRV. We made the provision expense. We will not do anything in this regard. Only the asset we will make the adjustment. Hope this point is very much clear. Guys, quickly respond. Only the one point I skip. Okay. Irrevocable. The election that we are doing, why we have to be analyze this? This election is a one time. As of today, irrevocable means once we made in the first return, it cannot be changed. The importance of the so far we understand the importance. Why we have to make the election. So far, we understand the importance why we have to make the election. And now we are saying, yes, this is the irrevocable. In the first tax return, whatever the election we opt, even by mistake, that it not suit to your business operation, it will remain there. It will remain there. Hope this point is clear most of the participant. Please quickly give me. This is irrevocable, and we already seen why we have to, what we have to do and why we have to do. The main scenario is clear. Main scenario is clear. As of now, we have the participant is 30, but I believe not all the participants are active. Still some participant is not responding on that. Let's move to the election 2. Let's move to the next slide, the election 2. Thank you guys. Thank you guys. Why I'm asking your participation to keep involved in our communication and understanding why there is a two category A and B. See again, A and B, I just give the names. There is no separate names in the return. Here the option. Here the FTA give us the option, which means we have the option, which option is matched to our business operation. We can opt for that. This is not the mandatory. You can go either one. FTA are the tax authorities facilitating the business. Maybe they, let's say if you have the money, if the company have the money, you can pay the tax in the current year and avoid all this hassle, all this, the calculation. If the company or the employer or the client ready to pay the money or the tax in the current year, so we can opt for the no realization basis, means we say no. So everything will be go on realized basis. In the current year, everything will be taxed. Again, see, the bifurcation means if the industry say, okay, in terms of the revenue item, whatever the adjustment, because the inventory, so if the industry norms or the operation is says, okay, this is not the bifurcation. Again, this is the additional option. You see the option that match to your industry or your operation. That you will see, okay, because mostly in my business, adjustment for unrealized basis belongs to revenue item, but I don't want to, and mostly this is the actual or near to actual. There is no change, and mostly is coming in terms of the loss, the inventory case, NRV case. So mostly the industry then coming as a loss. So why I have to bother? Why I have to bother to keep the calculation? To keep the calculation and the future year once it's sold, then I will adjust. Because if you opt for the election and realization basis, you have to keep the recording of the supporting document and the analysis that in the year in which it will be adjusted, you have to give the supporting document also when the FTA is required. So you have to keep all the documentation. This is the additional administrative work. So if you're saying, okay, I don't want to put my team in such scenario, normally in terms of revenue, I don't feel any difference in terms of the realization basis and unrealization basis. Mostly result is outcome is same. There's only the exception because the land and building, that may be the one-time event in the future. The plant and machinery, maybe after 4 year, 5 year, one of the event. Okay, that we will see upon the actual sale, upon realization basis. As the accounting, we are doing the adjustment, but I don't want to pay the tax, because in case of land on building, if your land value is a 10 million and land revalued is to 15 million, so on the 5 million, if you opt for unrealization basis, you might pay the big amount of tax. What is the rationale? If you have the money, okay, pay to the tax authorities. When you pay to tax authorities, you will not get the refund mostly. This is our understanding. In terms of the refund, we might get the tax credit, but we will not get the refund. So what is the important factor? What is the important factor? We are from, most of us maybe belongs from the accounting background or finance background. So what is the major factor? Each operation, the cash flow. Each organization, the financial part, the financial team who's managing the financing of the organization, cash flow of the organization, this will be the, the free of cost, the cash flow advantage, the financing advantage, that amount. Okay, even that same amount you will pay after 4 years, and you are not paying this year. If you offer the realization basis, even the value of the increase is the 5 million is a genuine. But why you want to pay the tax on the 5 million? Just take the 9% of the 5 million. Just for our understanding, you can think from the cash flow perspective also. You can improve the cash flow also. Hope this point is clear, Ms. Rana. Hope your understanding is refined now. Option A and B, we just give as a our understanding purpose. We will discuss in next slides. Okay. The point I'm saying, analysis under realized basis cash flow management will be good, resulting deferred tax may be recorded. Okay. Now we will see that what will be the scenario where the deferred tax will be recorded. Under which scenario the deferred tax and deferred tax liability will be there. But as of now, we seen the cash flow management may have the impact. Accounting point of view, maybe net impact will be same under all point. See the accounting impact. See, most of the if we are part of the any professional body like ACCA or the ICMA, ICW, so most of the we go through understand as the accounting point of view. So we are, and there is a many expert in the professional in the market. They say we are maybe the good accountant, but not the good analyst. Maybe the not good analyst. Okay, so how come we are not the good analyst? Because as the accounting, we will say, okay, the net impact coming is 0. So why we have to take all this headache? So as a business owner or as a finance person of the organization, he is looking the other factor also. Other factor also, that is the cash. As an investor, as the owner, as the employer, they don't want to pay the cash in the current year if there is a possibility that can defer for the future, that can be defer in the future. Now the deferred tax asset, okay. So this 5 million, that gain is arrived, okay. You will not pay the tax in this year. So what you will do? You have the recording, okay. You have the recording. So which means you have to pay the tax in the current year on this gain, but you are not paying due to the realization basis. So what you will do? You will record the deferred tax liability, because in future you have to pay. In future you have to pay on this amount. On the vice versa, what is the deferred tax asset? What is the deferred tax asset? Because what you will do in the financial statement, city competition point of view, you have these asset or liabilities, you have to present in that way also. So if you have the loss, the asset value is 10 million and the market value is 5 million, the 5 million is a loss. So if you record in this year, if you record in the current year, you will pay the less tax. But we said, okay, it will be the realized basis. So now this 5 million loss will not be adjusted. In accounting is adjusted, it will be added back. And now this 5 million in future, this will be reduce your tax liability. How? Taxable income. It will reduce your taxable income. So which means the deferred tax asset that in future will reduce your taxable income, that will be part of deferred tax asset. Hope, Nishara, your point is got clear. asset held on capital account refer to asset that are asset held on capital account that refer to the asset that are not trade, are the assets that are eligible for depreciation, and the asset under the applicable accounting standard, property, plant and machinery, immovable property, intangible asset, and any other current asset. And it is pretended to note the impairment loss related to investment satisfying the participation exemption will not be considered for the taxable purpose. We will go through this point in the upcoming slides, and that will have the understanding, but the main point, the analysis, hope you got clear. I'll just make the next. Election realization basis. This is the same we already seen in the example. This is the same. The same. Would the taxable person like to elect to use the realization basis? Yes or no? We are saying no. To recognize certain, we already go through. If any, I hope this point is very much understandable. This election taxable person recognize certain unrealized gain and losses for corporate tax on realization. Realization would occur when, for the example, a relevant asset is sold and disposed or terminated. Election allowed taxable person to recognize certain unrealized gain and losses for corporate tax purpose on realization basis. The option we already discussed is what is the option and what is the plus and minus. We said no, so what is the plus minus? And this election is irrevocable. The same. This we already discussed. That quickly we'll go through. If we say yes, so what is the next option is appearing? It is the same way. How it is appearing here in the tax return also will be appearing in the same fashion. Okay. So realization basis, then the below option will be appearing. If we say yes, no further option for selection disabled, because by default only one option will be remain there. So no option. But if we say the no, now we are just taking the example. Would like person yes. Now here we said the taxable person, person and the bank, taxable person, a bank and insurance provider. No. What is the next option is appearing? This is the next option is appearing. So same we already understand all asset, the capital plus the revenue. The second way, the below is shown the all asset on the capital. This is the, so one of them we already understand. Here the business that are prepared financial statement using the we are just here. If you want, I can go through, but the main topic and the basic theme of this election, hope the most of the participant is understand. Using the accrual basis accounting may elect to take into account gain and losses. Okay, this election can be made either in relation to all asset and liability that are subject to fair value and impairment accounting under the applicable accounting standard IFRS or IFR for SME. We have to see under we can opt IFR SME is optional, but less than 50 million you have the option to choose for IFR SME, but more than 50 million IFR, full IFR is applicable. Only the asset that held on the capital account. An election to apply the realization basis must be made by the taxable person during the first tax period. This is the irrevocable, and the first tax period this will be appearing. And how it will be appearing? This is the return that we seen that the election is irrevocable except under exceptional circumstance subject to the FTA approval. Guys, this point is clear. This point is clear. In terms of the election, I'm putting the relevant clause from the return and how is appearing, This is just additional information. Hope this point is most of us is understand, but I just added the additional revenue item we already understand, like financial assets, stock, inventory, okay, unrealized gain and losses. So now the topic that we gonna understand as part of the taxable income under Article 20, we are making the taxable income as under accounting Article 20 of city law. The eighth adjustment in the accounting profit we are doing while tax competition. So our so far the point is we are discussing unrealized gain and losses, from how it will appear in return, what are the election, and we already seen that. So let's see over here. Now the word realized when the asset is sold. Unrealized means the unsold item is unsold, whatever the gain and loss, while in the position when asset is not sold, that is unrealized. So this unrealized gain and losses not equal to transitional gain and losses, both are different. There's a difference in transitional gain and losses. We will discuss what are the transitional gain and losses, but currently we are discussing unrealized gain and losses. Keep in mind, currently we are under transitional losses. The other topic, maybe unrealized gain and losses, will be part of that, but here we are only discussing the unrealized gain and losses. Unrealized gain and losses, not the same, the transitional gain and losses, both are different. Hope this point is clear. Election is required in the first city return, and this is the irrevocable. Now, please confirm unrealized gain and losses are irrevocable, or every year we can opt for this, What does it mean by irrevocable? Some participating saying is and when we can select the election, in which year we can select the election? What is the return time period? 9 months from the end of the 9 months from the end of the 9 months from the end of the tax period. This is the complete understanding. 9 months from the end of the tax period. What is the difference between tax period and the accounting period? What is the difference between the accounting period and the tax period? Guys, if you are okay, we will continue another 40 minutes for today's session, as we already, due to certain reason, we are not able to start. So we might cover this topic today. Just quickly, can we continue another 40 minutes? I appreciate if you spare another 30 minutes. We will try to close 10:30. I'll maybe before that, because now we already have the whole understanding. So let's complete this topic. Just bear with me. The 30 minutes approximate. Let's go to move forward. Okay, now if the no election, city pay city on unrealization basis, what are we saying? Election is required in the first return, irrevocable, and we are saying no election. No election means, what is the no election mean? What is the no election means? I appreciate, guys, be with me on this topic. Your question will be understanding in the upcoming slide. Try to be with me in where we are so far. What is the definition of no election? By default, when we opt for the no, we opt for the unrealization basis. Not opting means, yes, we are not opting. What is the definition of not opting? What is the consequences of not opting? Whether not opting is the beneficial for the organization. Maybe it's not beneficial for the organization. So your understanding must be clear. Not opting mean unrealization basis. Unrealization basis means all the profit or losses will be go to profit and loss. And if you have the more profit in the current year, you will pay the more tax. This is the meaning of no election. Now the next is the if yes election election is made on realization basis. The two option, we have the two option: revenue, unrealized gain and losses adjustment in the city competition. We have the two option: unrealized gain and losses adjustment in the city competition. Okay, what are the two option? One, election A, and we understand election A, all asset and liability. So under election A, all asset and liability, and the current asset plus under the current asset revenue item. Under current asset, the revenue item. So what is the revenue item? Revenue item means short-term item. The short-term item, the definition, this definition will be as per the accounting standard, as per the applicable accounting standard. Here, if we say yes, so we will have the two options: unrealized gain and losses adjustment in city competition. Okay, first the election A, where all asset and liabilities, under all asset and liability will be current asset, under current asset will be revenue items, short term trade stock or inventory. Next is a non-current asset. Under non-current asset, capital item, long-term asset, land, building, plant, machinery, investment property. Now, before coming to this slide, did we cover this topic? Did we have the understanding what I'm discussing on this slide? Did we already go through in this session? Quickly, please, yes or no, yes or no. So now this slide making the flow in your understanding, connecting the points in appropriately. Okay. The next, the election B. The next is the election B. We have the option A and B. The second, we can opt for the B. Only capital item, the capital item we already knows previously. The capital item we already knows. Now, here's the additional information is shown. So what are the additional information? These 2 points I'm highlighting here, 2 points. First, under accrual accounting, In which scenario fair value model, revaluation model, record asset and plus liability in the financial statement at market value. Such gain and losses are unrealized. Such gain and losses unrealized. Before in that, the one of the participant highlighting this point also. So one of the participant highlighting this point also. So now this point, here the IFRS, understanding of the IFRS will be most important. Understanding of IFRS will be most important. What is the fair value model? What is the revaluation model? Okay, as a result of the applying this model, the gain will be recorded in the profit and loss, or gain will be recorded in the OCI, other comprehensive income. So if we knows this, so then we will make the adjustment. What does the mean in the OCI? OCI means our city computation is starting from the city computation starting from accounting profit before interest and tax, right? But if some adjustment is not recorded over there, it's recorded below under the OCI, so there will be no adjustment while doing a city computation. We will go through in the later on. Here we have the one small example, property asset example, market value. MV is the market value, net book value of the asset is a 10 million. Asset is increase is a 15 million. The first scenario is a 15 million. Under accrual accounting, 5 million gain, but it is unrealized. So now the 5 million is a gain because our net book value was the 10 million, but the market value is the 15 million as the option. In one case, 15 million, the 5 million is a gain, but is unrealized, recorded in profit and loss. But city law stating make election, but city law giving us the option. The option means, do you wish to pay the tax now or the later upon actual realized, when the actual is realized or sale? Here the scenario is that if the 5 million, as if we opt for the option of realization basis, we will make in the year of sale the tax to the authorities. But we already have the detailed understanding on that. Market value, the gain is the 5 million. If the market value is a 15 million, gain is a 5 million. But on other side, the market value is 8 million, so we will have 2 million is loss. So we have 2 million loss. So accordingly, we will see the adjustment based on the election option that we opt for that. Let's go quickly to the next. Still, we continue the same. Unrealized gain and losses equal to transitional gain and losses. Quickly, unrealized gain and losses are same the transitional gain and losses. Quickly, guys, quickly, because now you understand the all the point, and it will be finished within 10 minutes. Accounting difference. This is accounting different model. Here the typo are accounting different model. Okay, accounting different model. What are the different models? Accounting model, fair value model, revaluation model, fair value model, revaluation model, cost model, asset plus liability. Asset plus liability, the market value of the assets and the liability. As the outcome will be gain and losses. We already seen that. And this is the we already covered this point. No election city pay on realization. First, when no election pay city on realization basis, we already covered. This is the same. This is just repetition of the previous election on realization basis. As in this, we already covered. We already seen that. Capitalized item. What is a capitalized item? Election B, only capital. Asset plus liability. See, in capital also, there is one more point. Under election B, asset as well as liability. Both sides this impact will be there. Both side impact will be there. Unrealized gain and losses will be there on asset and liability also. We have to do the calculation based on that. Comprehensive statement of comprehensive income. So here statement of profit and loss. Okay. What is the statement of profit and loss? It will be the sale minus the other expenses, profit before tax, operating profit of business, city competition starting point. Here we have to understand city competition starting from here. City competition starting from operating profit. We are using the profit before interest and tax. And here we may say profit before interest and tax. But we might say the operating profit, city competition starting point, then the finance income minus the France income. So here we have to just the yellow highlighted, we understand this. This is our starting point, because from the starting point, we will see whatever the adjustment above is done. Accordingly, we'll make the plus and minus. If there is no plus and minus, so accordingly, we'll see what is the treatment we are doing. If we not made some add over, some loss is added over above, and as per city, we have to exclude the loss. First, we have to see that item is exist or no. For this reason, we are saying the starting point. Retained earning. Here is another point. Retained earning available for shareholder profit distribution. Retained earning available for profit distribution of shareholder. Why I'm highlighting this will have the impact in the down the slide while understanding the OCI and the revaluation gain on and revaluation reserve. Next is the unrealized gain and losses may be recorded in either one of the following. Okay, maybe unrealized gain losses recorded either one of the following. In profit and loss, here what we are talking here in profit and loss we are talking about, it will be shown here. Okay, one option is that, and second is OCI, other comprehensive income. It will be recorded in the profit and loss and the OCI as per accounting standard, as per applicable accounting standard. And that our reporting team or the financial accounting team or the accounting team, they will do that. They will, as a tax consultant, as a tax professional, who will receive the financial statement that is made as per the applicable accounting standard with the appropriate disclosure. Then we will read that disclosure and notes. Then we will understand where is the such item is written. Such item is in profit and loss or the OCI. Because based on that, we will do the adjustment while doing city competition. Now, while doing city competition, here we are understanding the profit, statement of profit and loss. Here we are understanding the city competition starting point. Why we have to understand that? Because maybe the gain and losses is recorded in the profit and loss. Maybe the gain and losses are recorded in the OCI. What is the OCI? Other comprehensive income. Other comprehensive income item below recorded into balance sheet are others are other reserve as a capital item recorded into the balance sheet as a other reserve under our capital revaluation reserve. Okay. So maybe the item is recorded in the profit and loss, and maybe they are recorded in the OCI, maybe recorded in the OCI, and balance sheet is recorded. Because if item is recorded in the profit and loss, it will be part of the retained earning. But if item is recorded in the OCI, it will be recorded as a other reserve or capital revaluation reserve. Okay. Under accounting, below IFRS may impact for city competition. So under accounting, due to these standards, our adjustment may differ. Okay, let's say the revaluation gain as per the IS 16, IS 38, IFRS 6 exploration. Okay, so gain plus and the sign upward or plus is shown the gain, and the downward is shown in the loss or the minus. Under the revaluation gain as per IFRS 16, IS 16, IS 38, IFRS 6, recorded in the profit and loss, If the adjustment is recorded here, so we will see if already is the gain is added and loss is minus, accordingly we will do the adjustment while doing the city computation. But now in the financial statement, if the note, we will see equity investment, fair value through OCI, which means whatever the gain and losses is recorded here in OCI, which means there is no action. We will not make the adjustment over here. Okay, so this is the difference, because as long as the gain is not added, you will not minus. As long as gain losses are not minus, you will not add. Even this we have the realization basis. Even we opt for the realization basis, but we are starting from here. So which means there is no effect recorded in the accounting profit. Accordingly, we will not make the adjustment while doing the city computation. Now the debt instrument, gain and losses, up and down, up is gain, down is losses, through the fair value, through OCI as per IFRS 9. First the equity instrument, the second is the OCI. In the previous slides, in the previous discussion, we've seen that debt instrument. Next is the gain and losses. As a result of actual gain and losses, IS 19. So gain and losses 9, it will be recorded accounting standard. Okay, and accordingly the difference, why we have to understand, why I have to read the notes to accounts. This is the reason. If it's recorded here, we might make the adjustment, while might not make the adjustment. So after all this standard adjustment under OCI, then we will see the TCI, total comprehensive income. Let's move to the next slide quickly. Realization basis means will pay tax when asset is sold. Cash basis, just asset sold, realization based, the cash basis on the actual gain and losses, not on accrual basis at the market value without sale. Investor don't want to pay the upfront tax to the authority. He want to utilize the cash into the business. This is the value for money. And tax authority is allowing such option by giving the election option. We have very detailed understanding where the no election under cash basis. Under cash basis accounting, there will be no election option. Okay, automatic basis. No balance sheet. All expense and income are recorded. No capital versus revenue. Revenue less than 3 million. If you opt the cash basis, then you will not see the option of the election, the realized and unrealized election. Okay. Now quickly to the next. Whether election made on realization basis, we have to see the election made on realization basis under accrual accounting. No. Okay, which means we are not opting the election. Irrevocable, where these gain and losses are recorded. If we are saying the no, we already understand not opting for the election. What the mean of that? Unrealized basis. We will go on unrealized basis. So now we have to see where the gain and losses are recorded. Okay. If the gain and losses are recorded in the profit and loss, we will do nothing, because we already opt on unrealization basis, and all the adjustment in the profit and loss. We while doing the city computation, we will not do nothing. We will not make any adjustment. The next, if recorded in the OCI, then adjustment is, because here as per the city computation, we have to maybe the gain is minus and the loss is added as per the analyzation basis. But as per accounting standard, we made the debt instrument through the OCI, gain and losses recorded here. Now we have to make the adjustment over here. Next, the gain. Gain is if we record it here, then we will add the gain in the city competition, and loss is minus. Yes, now we are saying the election is opt. If we opt, then the two option will be appear. Election A for all, election B only capital. When here where the gain or losses are recorded. Up to here we understand. Now here our concern, where the gain and losses is not when, it's where. Okay. This is where gain and losses. In profit and loss, gain, if it is recorded in the gain, it will be minus. In city competition, the gain will do the minus. If it's the losses, loss will add while doing the city competition under election B. Okay. But we are looking for the capital asset. Now, the second, if it's recorded in OCI, do nothing. If just see here under election B, we are saying do nothing. Here, the no election, where on unrealization basis and profit and loss, everything is there, we are saying do nothing. Hope the point is understand. Hope the point is understand. Let's move to the next. So this is the very comprehensive example. The net book value is a 1 million. Life of the building is a 10 years. So what will be our depreciation? What will be our depreciation? What will be our depreciation? Guys, quickly. 100K. Okay, per year depreciation is 100K. Realization basis, election made. Upward revaluation. Asset value was 10 million. Now asset value is a 15 million. So 500 gain is 500 gain is in this position. Net book value was the let's say the 1 million, and now the market value is 1.5 million. The gain is a 500,000 unrealized gain recorded in the financial statement. But we made the election realization basis. We made the election option realization basis. Let's see the next. If realization basis, the 500,000 revenue less from the profit before tax. So realization basis, we have to make the adjustment in the accounting profit while computing the taxable income. Now, we are continuing the same example. The first year, the depreciation. Now, after the revaluation, what here very important concept. Guys, keep focus on another only the few 5 to 10 minutes. Just understand this concept. So far, we already understand the major part, and this is one of the key area. You guys, I need your attention and focus on that. So now we said the valuation is 1.5 million. Net book value was 1 million. And here's the 1.5 million. The gain is 500,000 unrealized gain recorded in the income statement. 500,000. We will adjust that 500,000. Will adjust while doing city competition. But on the other side, our asset in accounting is recorded 1.5 million. So what will be the depreciation? Here we just adjust the revenue. But now we have to see the second part, because at the revenue we already adjusted. The gain we already adjusted. Actually, this is the 500,000 is the gain. We will adjust. It's not revenue, although gain is a revenue. we already adjust from this profit before tax. But on the other side, asset is in a balance sheet at the value of 1.5 million. The original value was the 10 million. Now the initial depreciation is appearing 100K. Now what is our depreciation in year one? In the year one, what will be our depreciation? Quickly. So what is the change in the value? What is the increase in the depreciation value? What is the increase in the depreciation value? And why this is increase? And why this is increase? And why this is the increase? So this value 50K depreciation against the revaluation. The 50K that the our balance sheet, our asset is revalued. Now this additional depreciation, the 50K is additional depreciation as a result of revaluation. So now tax authority is saying this additional depreciation, okay, the depreciation you can adjust. The depreciation will be allowed if the net book value is equal or less than 1 million. That's before revaluation. What is the tax authority saying? Whatever the depreciation you are recording so far, okay, is all 100% disallowed. All 100% disallowed. But normally the depreciation is 100% allowed if it is compliant with the accounting standard. And then normally previously we understand the depreciation if as complying with the accounting standard is allowed or disallowed. Is allowed or disallowed? Please quickly respond on that. In the normal scenario, we understand under depreciation expense is allowed, 100% is allowed. Election have no impact. No impact. Okay, now we understand that in the standard situation we are saying, depreciation 100% allowed. Now under this scenario where we are opting for the realization basis, and and realization basis, we understand the additional gain, the half a million, we will minus from the accounting profit that is already added. We will minus. So which million our taxable income is reduced now. This is the one part that we understand as part of the unrealized gain and losses under the revaluation. Now the second part we discussed, there will be a deferred tax asset and deferred tax liability. Right? So this half a million, the gain in future, it will be our the amount of tax we will pay on this half a million. It will be our liability or asset. So now, guys, point by point, I'm explaining the topic. Point by point, I'm explaining on each point. I'm highlighting what is the deferred tax, what is the liability. On step by step, we are understanding. Okay, up to here, we understand the half a million we will less from the accounting profit while doing the city competition. Now, the next we are saying this half a million, 9% of the tax is the tax liability in future we will pay. Now, the next point I'm highlighting over here, the depreciation is a disallowed. 100% disallowed under this scenario. Go and ask your team member, go and ask in your the community, where in the professional community, ask this specific points that we are learning in this session. Ask them, will they are able to answer on that? discuss with them. When you discuss with them, explain to them your concept, your understanding will be refined, and they also will be they also will be take the new understanding from you guys. Okay, that understanding as per the tax compliant. Okay, here we are saying that this additional depreciation 150 is a disallowed 100%. He's saying this depreciation will be allowed when the net book value, here the net book value is a 1,350,000. He's saying when this value is coming below the 1 million, whatever the amount that reduce the 1 million, that will be allowed. That will be allowed. Let's move to the, here we are saying because as of now, our net book value is a 1.5 million and our depreciation is a 150K. 1.5 million minus 150, net book value is a 1.3 million. So which means, so still our net book value is above the original value of the asset, original value. Tax authority is saying as well, here we said the gain is, here the gain is on realization basis. So accordingly, the depreciation of such gain would also will be on realization basis. We know the matching concept. We know the matching concept, right? So if we are here, we are saying that this gain is not taxable. So accordingly, the expense, depreciation expense against the same gain would not be deductible also. Again, the expense of that gain would not be deductible. Ms. Rana, here 50K, I give you the understanding, you will come on that, but here we're saying whatever the depreciation, even the 150K, the total depreciation, what they're saying, whatever the depreciation coming, that we will adjust against 500,000. Whatever the depreciation coming, we will adjust against 500,000. So 500,000, this 500,000, 100%, the depreciation 150, we are considering for city competition against the 500,000. We are not calculating over the 500,000 divided by 10. Here we are considering the first, they're saying the full depreciation expense that is coming, it will be consumed against the unrealized gain. And when the asset value is fall below the 1 million, that is the original value of the asset, that amount of depreciation will be deductible. Let's move to the year 2. Let's move to the year 2. In year 2, the another depreciation 150. So now our net book value was 1.3. Okay, 1.3. So the year 2 depreciation 150. Net book value is 1.2 million. In year 2, still our value is more than in year 2, the Mr. Hamza, I just answered. Hope you understand this point. The first, the whatever the depreciation is coming, yes, still is disallowed. Okay, whatever the depreciation is coming. Okay, whatever the depreciation in first, all the depreciation we have to allocate against this 500,000, because once this 500,000 will be burned in the depreciation against the depreciation amount, if utilized, first all the depreciation you have to allocate against that and make it 0. So we are saying once the asset value is coming less than 1 million, that is the original value. That is the original value. Here we said when the asset is net book value was 1 million. After that, whatever the depreciation that will be allowed. In the year 2, we made 150K, but still is above the original value of the asset, 100% disallowed. 100% will be disallowed. But this depreciation now is a disallowed, but it will be allowed in the year of sale. It would be allowed in the year of sale. Let's move to the next. This will be our deferred tax asset. in the year 1, 150K will be recorded as a deferred tax asset. This depreciation will not be wasted. This will give us the deferred tax asset. Keep in mind, the disallowed in the year 1. On the other side, he's built up our the deferred tax asset. Year 1, the deferred tax asset against 150. The year 2, deferred tax asset against 150. Now the year 3, again, still the net book value is above the 1 million, 100% disallowed. And this 150 will be increase our deferred tax asset in the balance sheet. Okay, year 4, 150, our net book value was 1,050,000. So now our net book value is a 900, which means original value is the 1 million and now is reduced to the 900. So which means 100,000 depreciation is allowed and 50 because still above the original value, that is a disallowed, and it will be part of our deferred tax asset. Hope now you guys understand the deferred tax asset. We build the deferred tax asset. We understand the amount of disallowed and deferred tax asset. Above disallowed depreciation to be recorded as a deferred tax asset due to difference or the different treatment in accounting and tax. This deferred tax is coming due to difference in accounting and tax treatment. But it is a temporary, means upon sale, all will be utilized as expense account, expense out against the capital. In the year of sale, this deferred tax asset and liability will be adjusted. Hope we understand the deferred tax asset, deferred tax liability, and this is we understand this is a temporary difference, and this will be adjusted in the year of sale. Why we have capital gain or loss arise upon sale of asset? Now the question is why the capital gain or loss are arising upon sale of asset. See, in the if the again gain is arising, so the same treatment you will continue. The same treatment will be continued. Year 4 is not clear. Ms. Rana is saying year 4 is not clear. Okay. I'll come to here. In year 3, what is the net book value? What is the net book value? Ms. Rana, quickly, at the end of year 3, what is our asset net book value? Ms. Rana, quickly respond, please. At the year 3, what is our asset net book value? Okay, 1,050,000. 1,050,000. Okay. And in year 4, what is the depreciation? 150. Okay, 150. So what we said, if the depreciation would decrease, bring the asset value lower than the original value, that much amount of depreciation will be allowed. Because until unless the asset value above the 1 million, that is the part of the unrealized gain. So this 50 million we recorded here as a deferred tax asset against this. If you just understand at the year end 4, if you quickly at the beginning of the year 1, at the beginning of the year end, here let's assume here this is the year 1 and the year 0. Year 0. Okay. What is the year 0? Where the building value is 1 million, and that at the end of the first year, okay, at the end of the first year, the asset was revalued to the 1.5 million. Right? If asset at the year end were valued 1.5 million, so we have the $500,000 we minus from the profit, accounting profit. And as a result, we have the deferred tax liability, right? Deferred tax liability against this $500,000, right? The deferred tax here, the deferred tax liability will not be the $500,000. $500,000 into 9%. $500,000 into 9%. It will not be exact, but tentatively we are saying the 9% of the maybe effective rate is different. Maybe effective rate is a different. Okay, maybe because 375,000 or other tax reducer will be there. So effective rate may differ, but let's assume equal to 9% of this amount will be deferred tax liability. Okay. So again, in the year one, where we said the 150 depreciation is disallowed, we said this 150K will be deferred tax asset. Here we made deferred tax liability, and every year we are building deferred tax liability 150K into 9%. So at the end of year 4, this what is the amount of this $500,000? Would you please take the 9% of the $500,000? 45K. Now, would you please take the 9% of 150K? Would you take? Okay. Now here, just understand the concept. In the year one, in the beginning of the year one, we have the deferred tax liability 45,000. But do we have the deferred tax asset? Do we have the deferred tax asset? No. But in the year one, the deferred tax asset is a 13,500 against 150,000 depreciation that is a disallowed. We said against that it will be recorded. Against that it will be recorded. But either here we will go the 9% or we'll take the same amount, because the same amount, instead of taking the 9%, you take the original amount, because that is the because the effect is a 9%. We have to keep the calculation, but just keep the same 13,500 in the year one. It will be go to the deferred tax asset. In year 2 also will go to the 13,500 as deferred tax asset. Year 3 also the same, and year 4 also 50,000 into 9%. Now please calculate what is the total amount. So which means at the end of year 4, we have the deferred tax liability 45,000, deferred tax asset is a 45,000, net effect is 0. Now, Ms. Rana, the concept was in year 4, because this 50,000 depreciation is disallowed. Why disallowed? Because the asset value is above the original value. Whatever the amount above the original value, against that 100%, first we allocate 100% depreciation to that amount. Okay, thank you, Ms. Rana. Let's go to the quickly, because we are trying to close this. Now the downward revaluation. Where first we see the upward revaluation, now the downward revaluation, and we are winding up here. Market value, here was the market value, the 1 million, and here is the market value, the 8 million. So what will be the loss? What is the loss? To be recorded as a deferred tax asset as a temporary difference upon sale of expense out against in the capital gain on the year of sale. So this, against this 200K deferred tax asset will be recorded, and this 200K will add back into the accounting profit while computing the city. So the same way the calculation here, we are calculating the depreciation, because this net book value is less than 1 million. So if the net book value is less than 1 million, whatever the depreciation is coming, all allowed. Only the depreciation above the net book value all the depreciation, first we allocate to the asset value or the market value of the asset to make the whatever the extra amount to zero. When the assets start coming below the original value amount, the difference between the original asset value or the net book value, below that amount is allowed. Thank you very much, guys. Thank you very much, guys. I'm going to stop here. The most of our topic is covered. You may leave that and hope this topic is interesting and you understand the technical point as best as I can do. I tried my level best to cover this topic. Thank you very much.